Forget the glittering suits and the incessant flurry of deals that instantly mint millions. True success on Wall Street, measured not merely by fleeting gains but by enduring wealth, sustained influence, and profound psychological resilience, is rarely the result of mere chance, extraordinary luck, or an uncanny ability to predict market movements with a crystal ball. It is a deeply ingrained process built upon daily discipline, unyielding psychological fortitude, and a set of often unexpected, almost invisible habits that fundamentally shape the mindset and behavior of the wealthiest players. These individuals don't just know what to do, they embody how to be. Today, we will demystify the path to financial mastery and peel back the curtain to reveal 10 counterintuitive yet critically important habits that distinguish those who reach the pinnacle and remain there from those who merely dream of it or experience a brief, volatile surge of success. These habits are not secret trading strategies, complex algorithms, or exclusive insights available only to a select few. They are fundamental approaches to life and work that transform ordinary individuals into extraordinarily effective traders and investors. Each habit, seemingly simple in isolation, collectively creates a powerful synergistic effect, forging a personality capable of withstanding immense pressure, making optimal decisions, and continuously adapting to the ever-shifting market landscape. Our objective is not merely to enumerate these habits, but to provide you with a profound understanding and practical tools that you can integrate into your own life, thereby enhancing your productivity, sharpening your thinking, improving your emotional regulation, and bolstering your ability to make decisions amidst high uncertainty and perpetual stress. Prepare to redefine your perception of the journey to financial success, for the true secrets lie not in what you know about the market, but in how masterfully you manage yourself, your mind, and your habits. This is an investment in your most valuable asset, your own potential. 1. Conscious meditation and mindfulness as a tool for emotional control. In a world where seconds dictate the fate of millions and market volatility can induce panic in even the most seasoned players, the ability to maintain calm, clarity of thought, and emotional equilibrium is absolutely invaluable. The wealthiest individuals on Wall Street understand that market success is not merely about numbers and economic models, but also about a deep comprehension of human psychology, which manifests in collective emotions: fear, greed, euphoria, and panic. This is precisely why conscious meditation and mindfulness have become, for many, not just a fleeting trend, but a daily, indispensable practice. The essence of this habit lies in the deliberate, systematic focusing on the present moment, observing one's thoughts, emotions, and bodily sensations without judgment or an attempt to alter them. This is not simply relaxation, as many mistakenly believe, but a scientifically validated method that literally changes the structure and function of the brain. Research conducted at Harvard and other leading scientific centers has shown that regular mindfulness practice increases the density of gray matter in the prefrontal cortex, the brain region responsible for executive functions such as decision-making, planning, impulse control, and working memory. Concurrently, it reduces activity in the amygdala, which is the brain's center for emotions, particularly fear and anxiety. This unexpected aspect transforms meditation into a powerful neuroplastic tool, enabling investors and traders to handle challenges like a ninja in financial markets. Instead of succumbing to irrational panic during sharp market fluctuations or excessive euphoria during rapid upturns, they maintain objectivity, the capacity for cold analysis, and detached observation of events. They learn to recognize emotional triggers before these impulses overwhelm their thinking. The practical benefit of this habit is multifaceted and directly impacts results. A significant enhancement in the ability to make rational and well-founded decisions, even under extreme pressure. Effective avoidance of impulsive actions driven by the fear of missing out, FOMO, or uncontrolled greed, which are primary causes of costly market errors. Mindfulness allows them to adhere to their pre-planned strategies and frameworks, even when others yield to emotional pressure and abandon their principles, ensuring more stable and well-reasoned outcomes in the long run. This forms the bedrock for sustained success in any highly competitive, dynamic, and emotionally charged environment. Awareness provides the capacity to step back from the emotional maelstrom, analyze the situation with a clear head, and make a deliberate, proactive move, rather than a reactive one. 2. Optimizing sleep as a strategic asset, not a sacrifice. In a culture that often romanticizes sleep deprivation as a badge of exceptional dedication, relentless hard work, and a willingness to sacrifice for achievement, the most successful financiers on Wall Street demonstrate an entirely opposite, counterintuitive approach. For them, quality sleep is not a luxury that can be postponed, nor an obstacle to be overcome. It is a strategic asset, an absolutely integral component of their daily productivity, mental sharpness, and capacity for effective leadership. The essence of this habit lies in consciously prioritizing 7 or more hours of high-quality, uninterrupted sleep each night. This is not merely rest, but a crucial period during which the brain actively works on memory consolidation, clearing metabolic waste, and restoring neural connections. These processes are critically important for maintaining optimal cognitive functions, which are indispensable for making complex, multifaceted decisions in a dynamic market environment. The unexpected aspect lies in the decisive rejection of the hustle culture that dominates many highly competitive industries, and a profound understanding of sleep as an essential part of productivity, rather than an impediment. They know that chronic sleep deprivation not only leads to physical exhaustion, but also significantly diminishes attention span, impairs memory, distorts critical thinking abilities, increases impulsivity, and heightens the propensity for irrational risk-taking. Studies indicate that even a single night of insufficient sleep can have the same impact on cognitive abilities as mild alcohol intoxication. The practical benefit of sleep optimization is multi-layered and directly influences financial outcomes. Significant improvement in memory, allowing for better retention, analysis, and integration of large volumes of market data, economic indicators, and historical precedents. Enhanced concentration, which is critical for identifying subtle patterns, hidden signals, and reacting swiftly to market changes without distraction. Increased creativity, aiding in the development of innovative and unconventional investment strategies that provide a competitive edge. And improved problem-solving capabilities, which are absolutely necessary for navigating unpredictable financial waters and formulating comprehensive solutions. Furthermore, quality sleep fosters emotional stability, reducing the likelihood of making decisions under the influence of stress, fatigue, or irritability. Investors who pay due attention to sleep not only feel better physically and psychologically, they function at a higher cognitive level, minimizing costly errors arising from inattention or poor judgment, and maximizing their chances for long-term stable success. This is not a waste of time, but a strategic investment in one's own brain and its capacity to generate wealth. 3. The practice of deep work and utilizing ultradian rhythms. In today's world, where constant notifications, an endless stream of emails, and myriad distractions fragment our attention into tiny pieces, to engage in deep, uninterrupted concentration has become not just valuable, but an exceptionally rare and strategically vital asset. The wealthiest players on Wall Street don't merely work long hours, they work deeply, extracting maximum value from every work period. The essence of this habit, popularized by Cal Newport in his book Deep Work, lies in consciously allocating 90-minute periods of continuous profound concentration on the most important, cognitively demanding tasks, synchronizing with the natural ultradian rhythms of human alertness. These rhythms, lasting approximately 90 to 120 minutes, describe natural cycles during which we can sustain peak mental performance, after which we require a brief break to restore energy and focus. The unexpected aspect of this approach is that instead of constantly switching between tasks, which merely creates an illusion of productivity and leads to Attention residue. These financiers focus on intense, focused blocks of work. They actively create sanctuaries for deep work, where all potential distractions, phones, email, social media, colleagues, are completely eliminated or minimized. This allows them to immerse themselves in complex analytical tasks, such as market modeling, developing investment strategies, in-depth company research, or analyzing macroeconomic data, without any interruptions or cognitive overload. They understand that true value is created not by the quantity of checked-off tasks, but by the depth and quality of intellectual effort. The practical benefit of this approach is immense and translates into tangible results. A significant increase in productivity, as the quality and volume of work performed grow exponentially when the brain operates in full concentration mode. Faster resolution of complex analytical problems, enabling them to identify investment opportunities and assess risks ahead of competitors. And effective development of strategies that require profound deliberation, creative thinking, and the integration of diverse data. Avoiding distractions not only saves time, but also reduces the number of errors caused by inattention or superficial analysis. This allows them not just to complete tasks, but to create value that demands the highest level of cognitive effort, which is key to gaining an edge in the highly competitive financial market. Implementing this habit means consciously creating conditions for maximum intellectual output, transforming time into genuine capital. 4. Applying mental models, inversion second-order thinking. In the complex, multifaceted, and unpredictable world of finance where intuition often fails, and linear, one-dimensional thinking inevitably leads to pitfalls, the most successful investors and traders employ a powerful arsenal of mental models. These are not merely abstract ways of thinking, but time-tested frameworks that serve as mental tools for better understanding reality, making more informed decisions, and avoiding common cognitive biases. The essence of this habit lies in the conscious and systematic application of various mental models, among which inversion and second-order thinking particularly stand out. Inversion, popularized by the legendary investor Charlie Munger, vice chairman of Berkshire Hathaway, involves thinking backward. Instead of pondering how to achieve success, which often appears to be a straightforward and obvious path, you actively ask yourself what would definitively lead to failure in order to avoid it. For example, instead of, "How do I make $1 million on this trade?" you ask, "What must I do to lose $1 million on this trade?" This allows for the identification of potential risks, hidden traps, and possible errors that might otherwise be overlooked due to optimism or confirmation bias. Second-order thinking is the ability to anticipate not only the immediate, instantaneous consequences of decisions, but also their subsequent indirect effects and long-term ramifications. This means asking not just, "How will this decision affect me now?" but "How will this decision affect me, other market participants, competitors, the economy, and the regulatory environment in a month, a year, 5 years?" It is a multi-layered analysis that demands a deep understanding of causal relationships. The unexpected aspect of these models lies in their decisive departure from linear, superficial thinking towards multidimensional systemic frameworks. This enables a better understanding of market complexity, its interdependencies and dynamics, as well as actively avoiding cognitive biases such as confirmation bias, herd mentality, survivorship bias, or overconfidence. They help to see the invisible, to think outside the box, and to re-examine problems from fundamentally different angles. The practical benefit of applying mental models is immense. A significant improvement in judgment, as you consider a problem from multiple perspectives, weighing all pros and cons. A reduction in costly errors as you actively seek out weaknesses in your plans and strategies, and to perceive hidden connections, non-obvious opportunities, and potential risks, which provides a significant competitive advantage in the market. This empowers investors not merely to react to the market, but to actively shape their strategy with a profound understanding of the potential consequences of their own actions and those of others. 5. Strategic philanthropy, more than just charity. At first glance, charity might seem far removed from the pragmatic, cutthroat, and profit-oriented world of Wall Street. However, for the wealthiest and wisest financiers, it is not merely an act of kindness or a way to give back to society, but an integrated, strategically conceived part of their overall capital management architecture. The essence of this habit lies in utilizing philanthropy as a multifunctional tool that serves not only social objectives but also reinforces financial standing and long-term influence. It's not just about giving money away, but about how to do so with maximum benefit for all stakeholders involved. They employ philanthropy to optimize tax benefits, which allows for a significant reduction in the tax burden on substantial wealth, using instruments such as charitable trusts, donor-advised funds, or direct donations. This enables them to preserve more capital in the long run, which can then be reinvested. Philanthropy is also a key element of estate planning, allowing for the efficient transfer of wealth to descendants or specific charitable organizations, minimizing inheritance taxes and ensuring long-term impact and the realization of family values. Furthermore, it can be a method of asset diversification, for instance, through the creation of charitable foundations that can invest in various asset classes, providing additional flexibility and protection. The unexpected aspect lies precisely in this multifunctional use of philanthropy. It is not a separate activity, but organically integrated into the overall financial strategy. Beyond direct financial gain, strategic philanthropy allows for the creation of an exceptionally positive public image and improved reputation. In a world where trust, connections, and social capital are no less valuable assets than financial ones, this can open new business opportunities, strengthen relationships with partners, clients, and even influence the political and regulatory environment. The practical benefit of strategic philanthropy is evident. Optimization of tax burdens through various charitable mechanisms, allowing for the preservation of substantial sums, the creation of a family legacy that reflects the family's values and vision, ensuring its longevity and positive social footprint, and the formation of a positive image and social capital, which can be as valuable as financial capital, opening doors to new opportunities and enhancing influence. This enables them not only to give back, but to do so intelligently and effectively, integrating philanthropy into their financial architecture, transforming it into a tool for achieving their broad financial, social, and personal goals. As we delve deeper into the intricate habits of Wall Street's most successful, it becomes clear that historical context and understanding the broader market narrative are just as crucial as individual strategies. For those eager to grasp the epic sweep of financial history and the personalities that shaped it, we highly recommend 50 Years in Wall Street. This is not merely a book. It's an immersive journey through two richly illustrated volumes of Henry Clews' memoirs, spanning half a century of Wall Street's tumultuous history, from the Panic of 1857 right through to the Gilded Age. Imagine gaining unparalleled insights into the minds of legendary financiers, witnessing the dramatic market manipulations that defined eras, and understanding the cyclical nature of booms and busts, all through the eyes of someone who lived and breathed it. This isn't just dry history. It's a vibrant tapestry woven with personal anecdotes and critical analysis that brings the past to life, offering invaluable lessons that resonate with today's market dynamics. By understanding the historical precedents of market behavior and the human element behind financial shifts, you gain a perspective that few possess, allowing you to anticipate patterns and make more informed decisions. Don't just trade the present. Understand the forces that shaped it. You can explore this fascinating historical perspective and learn from the giants of yesteryear by finding 50 Years in Wall Street through the link provided in the description. 6. Developing an inner scorecard, double asterisk. In a world where external metrics of success, the size of one's wealth, media recognition, high status, praise from colleagues and clients, are the mainstream and often misleading benchmarks. The most resilient and sagacious financiers on Wall Street navigate by a different, far more reliable compass: the inner scorecard. This profound concept, popularized by the legendary investor Warren Buffett, signifies evaluating one's own decisions, actions, and successes exclusively by internal standards, principles, and values, rather than by external indicators or the opinions of others. The essence of this habit lies in cultivating a deep, almost unshakable psychological independence. Instead of seeking external validation, succumbing to market pressure, following the herd, or reacting to criticism, they rely on their own clearly defined principles, convictions, and intellectual integrity. This means that their actions are not dictated by what the media might say about their investments, how competitors might react, or even how their clients might perceive short-term results. Their decisions are grounded in whether these actions align with their own high standards of rationality, long-term perspective, and ethical conduct. The unexpected aspect lies precisely in this psychological independence from the external world and its constant fluctuations. It allows them to maintain objectivity, consistency, and unwavering faith in their own strategy even during the most challenging periods. When irrational panic grips the market, and everyone else is selling assets at any price, an individual with a strong inner scorecard can calmly adhere to their long-term strategy if it aligns with their internal criteria of fundamental value. They are not afraid to appear foolish in the short term. The practical benefit of developing an inner scorecard is immense and directly impacts investment outcomes. The making of long-term, profoundly rational decisions that are impervious to the emotional pressures of the market, fleeting trends, or the temptation of quick profits. This enables a focus on truly valuable assets that may be undervalued by the market. Furthermore, it fosters resilience to setbacks, as internal evaluation allows mistakes to be viewed as valuable lessons for learning and improvement, rather than personal failures that erode self-esteem. It also contributes to preserving integrity and reputation, which is critically important for building trust and long-term relationships in business. This habit empowers them to remain true to their investment principles, even when it is unpopular, and as history shows, such an approach often yields the greatest dividends and builds true wealth. 7. Extensive and diverse reading as the foundation of compound knowledge. Double asterisk. In a world where information is available in abundance, yet true wisdom, the ability to see hidden connections and to draw far-sighted conclusions remains scarce. The most successful investors on Wall Street don't merely read, they immerse themselves in reading as a fundamental daily form of work. For them, reading is not a leisure activity, but an investment in intellectual capital that compounds over time. The essence of this habit lies in daily, purposeful reading for several hours, encompassing not only highly specialized financial analytics, company reports, and economic news, but also an extraordinarily broad spectrum of disciplines: history, especially economic and social, biographies of eminent individuals, scientific works in physics, biology, psychology, philosophy, sociology, and much more. The unexpected aspect is that reading serves as their primary form of work, for accumulating knowledge that not only expands erudition but also compounds over time, creating a powerful synergistic effect known as compound knowledge. This compound knowledge is not simply the sum of individual facts, but an integrated, holistic worldview that allows them to perceive connections, patterns, and cause and effect chains that are inaccessible to those who limit themselves to the narrow financial sphere. For example, historical knowledge helps in understanding market cyclicality, human nature during economic crises, and societal reactions to innovation. Psychology reveals cognitive biases that influence investment decisions for both individuals and entire markets. Biographies of successful people illustrate mental models, decision-making strategies, and approaches to overcoming difficulties. Studying science can offer insights into future technological trends and their potential impact on the economy. The practical benefit of such extensive and diverse reading is enormous. The development of critical thinking, which allows for deeper analysis of information, separating signal from noise and forming independent conclusions. An expanded worldview helping to see the big picture and the context of market events and to anticipate long-term shifts. The identification of non-obvious patterns and correlations that may indicate future trends and undervalued opportunities, and the formulation of unique investment ideas that are not mainstream but hold high potential for outsized returns. This enables them not merely to react to superficial information, but to interpret it from a multidimensional perspective, leading to a deeper understanding and, consequently, better, more robust, and innovative investment decisions. Reading becomes a source of continuous intellectual growth, which is the key to long-term advantage. 8. The principle of subtract, don't add in productivity. In a world dominated by a constant urge to add something new, new productivity tools, new time management methodologies, new productive habits promising instant results, the most effective financiers on Wall Street often employ a counterintuitive yet immensely powerful approach: the principle of subtract, don't add. The essence of this habit lies in the active, conscious removal of distractions, unnecessary tasks, and superfluous commitments from their daily schedule in order to free up precious cognitive bandwidth and focus exclusively on what truly matters and delivers the greatest value. This is deliberate simplification, not complication. The unexpected aspect is that instead of perpetually adding new productive habits or tools, which often leads to overwhelm, attention fragmentation, and system noise, they concentrate on radical simplification and the elimination of obstacles. They understand that our cognitive energy is a finite resource, and every distraction, every unnecessary decision, every low-value task depletes it, diminishing the capacity for deep analysis and optimal decision-making. Thus, they actively identify and eliminate noise. They turn off notifications on their phones and computers during work, resolutely decline meetings that are not directly pertinent to their key objectives, delegate or completely abandon tasks that do not yield substantial value, and limit time spent on news consumption that is not critically important. They often apply the 80-20 rule, focusing on the 20% of efforts that generate 80% of results, and ruthlessly eliminating the rest. The practical benefit of such an approach is extraordinary and directly impacts effectiveness. A significant increase in focus on key tasks, allowing for maximum attention to the most crucial investment decisions, deep market analysis, and strategic planning. A reduction in information noise and mental clutter, which often hinders clear thinking and informed decision-making, especially under conditions of high uncertainty, and effective prevention of burnout, as fewer distractions and unnecessary obligations mean less stress, less wasted energy, and more opportunities for recovery. This enables them to concentrate their energy, intellect, and time on the few critical actions that yield the greatest results, ensuring not only high productivity, but also resilience and long-term effectiveness in the exceedingly demanding financial environment. 9. Impatience for losses, patience for profits. This is one of the most crucial psychological habits that consistently distinguishes successful traders and investors from the vast majority of market participants. Human nature has a deeply ingrained tendency to cling to losing assets in the hope of their recovery, refusing to admit error, and to prematurely lock in small profits, fearing their loss. The wealthiest players on Wall Street actively combat these inherent cognitive biases, which are among the most costly in the market. The essence of this habit lies in a strict, uncompromising discipline regarding the swift closure of losing positions as soon as it becomes clear that the initial investment thesis has not materialized, or the market is moving against expectations. Concurrently, they demonstrate extraordinary patience, allowing profitable trades to develop without haste in order to maximize their potential. This demands exceptional emotional resilience, rationality, and the ability to act contrary to natural instincts. The unexpected aspect lies precisely in overcoming the natural human tendency known as the disposition effect, The psychological inclination to sell assets that have risen in price, to lock in profits, and to hold assets that have fallen in price, to hold losses, hoping for their recovery. Successful investors consciously resist this, understanding that cutting losses short is a fundamental principle of capital preservation. They establish clear stop losses or mental limits for losses and adhere to them without hesitation, preventing small losses from escalating into catastrophic ones that could wipe out a significant portion of capital. Conversely, they are patient with profits, allowing their winners to run, rather than realizing insignificant gains out of fear of losing what has already been accrued. They understand that substantial profits often require time and the ability to withstand temporary pullbacks. The practical benefit of this habit is colossal and directly impacts long-term results. Minimization of losses, which is the first rule of market survival, as preserved capital can be redeployed into new, potentially profitable investments. Maximization of potential profit, as allowing successful trades to run, enables you to harness their full potential, letting compound interest work for you. And the preservation and growth of capital in the long term, which is the foundation for accumulating true wealth. This habit embodies the wisdom. Let your profits run and cut your losses short, and it is a cornerstone of successful trading and investing, allowing for the construction of a robust and profitable strategy. 10. Conscious and strategic networking beyond superficial connections. In a world where information is currency and trust is the key to the most valuable doors, the wealthiest individuals on Wall Street understand that their network of contacts is one of their most precious, if not the most precious, assets. However, their approach to networking differs significantly from superficial business card collecting or casual encounters. The essence of this habit lies in the purposeful, conscious, and strategic building of deep and meaningful relationships with key industry players. Influential investors, leading analysts, successful entrepreneurs, regulators, and top company executives. These are not accidental meetings, but thorough preparation for each interaction, a focus on mutual value, and a systematic approach to expanding and deepening their network of contacts. They seek opportunities not only to gain information or support, but also to provide value to others, creating long-term partnerships built on mutual trust and respect. The unexpected aspect is that this is not merely collecting business cards or attending social events, but a profound investment of time and effort into forming genuine, significant connections. Such connections can unlock unique opportunities and insights that will never be available to the general public through public information sources. This could be exclusive early information about market trends, access to private investment deals, invaluable mentorship from seasoned market participants, the ability to influence industry standards, or even collaboration on new ventures. What matters is not the quantity of contacts, but their quality and the depth of the relationships. The practical benefit of conscious and strategic networking is invaluable. Access to exclusive information and insights that can provide a significant competitive advantage and enable more informed decision-making. The generation of new ideas and perspectives arising from exchanges with industry leaders and diverse experts. The discovery of potential partnerships that can lead to synergy, new enterprises, and expanded opportunities. And mentorship, which is priceless in the competitive world of finance, helping to avoid common pitfalls, accelerate professional development, and gain wisdom from those who have already trodden the path. This allows them not only to stay abreast of developments, but also to actively shape the future of the market, leveraging the collective intelligence and resources of their high-quality network. We have just unveiled 10 unexpected yet immensely powerful habits that form the bedrock of success for Wall Street's wealthiest and most influential individuals. These habits demonstrate that reaching the pinnacle in the financial world is far more than just possessing deep market knowledge, the ability to react quickly to news, or mastering complex algorithms. It is a deeply ingrained philosophy of life and an approach to work founded on uncompromising self-discipline, unwavering psychological resilience, and exceptionally sharp strategic thinking. From conscious meditation, which enables emotional regulation amidst rampant market volatility and uncertainty, to strategic networking, which opens doors to exclusive opportunities and insights. Each of these habits is an integral building block in the edifice of sustainable wealth, long-term influence, and personal fulfillment. They underscore that true, lasting market advantage stems not from external circumstances or sheer luck, but from an internal transformation, from who you become as a person and a professional. We sincerely encourage every trader and investor not merely to ponder these habits, but to actively and purposefully integrate them into your own life. Do not attempt to change everything at once. Start small. Choose one or two habits that resonate most with you or where you feel the greatest need for improvement, and begin practicing them daily with consistency. This is the path to achieving not only impressive financial success, but also deeper personal growth, leading to a richer understanding of yourself, your capabilities, and the world around you. Remember that investing in yourself, in your mind, your discipline, and your well-being is the most profitable and secure investment you can ever make. It will yield dividends that extend far beyond mere financial metrics. And if you aspire to delve even deeper into the psychology and strategies that forge success in the market, then there is one book that stands apart from all others. It is Reminiscences of a Stock Operator. Not merely a classic, but a Bible for anyone interested in financial markets. We are thrilled to present a new edition of this timeless work, which offers a profound analysis of the psychology and strategies of the legendary Jesse Livermore. But this is not just a reprint. It is augmented with comprehensive commentary and analysis for each chapter, transforming his raw experience into practical, actionable lessons for the modern investor. You will discover how Livermore overcame emotional traps, managed risks, and built the strategies that allowed him to become one of the greatest traders of all time. This is not merely a recounting of the past. It is a guidebook that provides tools for the present and the future. Expert commentaries will help you apply Livermore's timeless principles to contemporary markets, giving you a unique edge. Through this edition, you will not just read history, but transform it into potent, applicable knowledge. It is an essential read for those who seek to comprehend market psychology and the mastery of trading. Find the link to the new edition of Reminiscences of a Stock Operator in the description of this video and add it to your collection. It will become your trusted guide in the world of high finance.